Hi there, and welcome to the Mint Asset Management update for March. My name is John Middleton, and I'll be talking you through the events of March and what continues into April. The reality was that March was pretty much all about tariffs, the fear of them arriving, and they did arrive on the 2nd of April. But the reality is, I think, as this slide demonstrates, it wasn't really about reciprocal tariffs for the United States, but more President Trump trying to balance the US's balance of payments. Hopefully this table demonstrates that it's not about the reciprocal tariffs, it's about how much the US is importing versus exporting to different countries. And the level of tariffs highlighted on those lovely two boards in the Rose Garden is that, rather than any particularly punitive tariffs being raised on the US relative to others. So I think that's the first thing you need to sort of bear in mind, is it's a balance of payments problem rather than a tariff problem. And to be perfectly honest, I mean, the size of the tariffs are so huge that it's pretty uneconomic for most of those countries with tariffs of over 10% to really do anything other than not trade with the US going forward. So, I think the China approach, which I'll come to, is interesting. But for the most part, I think this is a negotiating tactic from Trump, trying to encourage these people to tweak how they trade with the US. And I think, the reality is that this will continue as such going forward, albeit I would, clearly say this is a very unfriendly way of undertaking trade talks with friend and enemy alike. So, the reality to date, the only person that's really reacted is China. They've essentially raised similar tariffs back on the States, so we're back to square one. In some respects, I think that's a great thing to do. Again, if you're being bullied, pushing back is the only real response. And I think, certainly in China's situation, they have chosen to do that. Clearly, if these things stay in place, it's going to be a big impact for both economies. But I do think that Xi probably has more levers to pull, certainly in terms of domestic stimulus, the ability to move the exchange rate, et cetera, than possibly Trump has domestically. So watch this space, but hopefully we don't sort of escalate and escalate. Elsewhere, if you look to New Zealand, to be perfectly honest, as we've talked about before, basically a marginal impact in terms of headline trade. Really, the impact is probably more the second derivative, and particularly how these trade changes impact NZ, the US, and the Chinese economy, which are all major trading partners, and also more macro, what this means for inflation and interest rates over the medium term. The interesting thing is, if trading partners do change, maybe we get a bit of disinflation from higher trade with China. I suppose the one thing this table does highlight is it sucks to be in Asia, frankly. Obviously, the size of the tariffs there are just huge and very difficult to get around. For me, this is interesting, though. Obviously, I think China has looked to circumvent tariffs by essentially manufacturing in other countries within Asia. And for me, this is just a means of stopping that or reducing that impact going forward. But overall, clearly heightened uncertainty, lots of questions, few answers, and a very different way for the trade for the US to operate. The other thing I just flagged, it's quite an interesting move in terms of the bond market. Obviously, it was bought as the equity market was sold, certainly for the first couple of days, as a bit of a safe haven. And again, certainly the interest rate outlook globally has changed. Prior to 2nd of April, I think we were expecting a couple of cuts this year, and now we're expecting 3 to 4. But of late, we've actually seen the bond yields rise again. And I think this is basically the search for liquidity, i.e., there's been a few cash calls, we need to fund them. Initially, we started with equities, and then we moved into bonds to do that. I suppose the sort of final thing I'd mention about tariffs is we met with HMC Capital in Sydney a couple of days ago. One of their guest speakers was Julia Gillard, and she made the point that, notwithstanding the trade side of things, if Trump is willing to do this to his partners, particularly Five Eyes, but also Zelensky in Ukraine. I think there are deeper political ramifications over the medium term, which we've yet to see. But overall, heightened uncertainty, a lot of volatility, and a difficult time for markets. So what have we been doing? Well, to be honest, we've sort of been taking stock. We've been looking at price moves and really looking back at where our conviction lies within the stocks and sort of where analysing whether the new information really warrants the changes in the share prices and within a vast array of share prices which have been down year on year or month on month, where we think the real opportunity lies and where we see conviction. And essentially, we've been adding to areas where we see the risk reward working in our favour. The reality is it's been a bit of a perfect storm for the funds. We have the growth bias that hasn't gone down well. We also focus on large cap liquidity or liquid stocks. And the reality in this sort of environment is these are probably the first stocks that are sold down. And hence we had a pretty difficult end to March, particularly in the last couple of days. However, I would say that we think our approach is good over the medium term. If we do see market recoveries, then those liquid names will bounce back. And if we see further market selling, we would expect the less liquid part of the sector to be impacted going forward. So we remain pretty comfortable where we're positioned. If we move over and start talking about the funds, start with the NZSRI fund. The NZ market was off 2.6%, and we did underperform that. There were a few positives. I mean, Serco and Scales were both up for the month in what was pretty much a sea of red. But it really was those overweight positions that hurt, and particularly in the liquid side of things. And the reality is, I think a lot of the less liquid names within the New Zealand market just didn't really move in the last couple of days of the month. So I hope this chart on the right sort of highlights that. This breaks out sort of the sector or the index move through stocks. And I think obviously, most of the names or the tickers there are the larger cap names. But if you add those up and sort of basically subtract the rest, of that 260 basis point move for the index, only 50 basis points came from stocks outside the top 10, 15. And again, for me, that is the opportunity and the risk. I would highlight that, as we've been saying, the NZ market, while down 2.6%, did materially outperform other global indices. So the Nasdaq and S&P were off 8% and 6% respectively. And I do feel it remains a pretty decent place to hide, both politically and economically. And I do think that going forward, the market yield, which is now at least 100 basis points above a term deposit, will become attractive to institutional and retail investors alike. During the month, we did change a few things up. We added to positions where we see value in things like Spark, Fletcher Building, and Channel Infrastructure. And we funded this with lower conviction ideas, Stride, Ryman, and Port of Tauranga. Moving across to the Australasian funds, and again, a difficult time for both Australia and New Zealand, with Australia again underperforming the New Zealand market. Once again, it was about liquidity, and our NZ liquid positions sort of worked against us as the wider market, as those sort of big, large sector names were off more than others. And again, with exposure to Australia, the Australian market off 3.5%, weighed more than New Zealand market off 2.6%. Within the Australian market, I suppose safe havens, or those least affected, were utilities and resources, which is something of a surprise given the impact on China. But those sectors worst hit were technology, real estate, healthcare, and consumer discretionary. And then within the fund, we sort of felt that quite acutely through positions like Telex and Megaport, which were sold off, without really any view on underlying earnings or underlying impact of tariffs. And, for one, Telex has just come out and said they're unlikely to be affected by any tariff changes. Again, we were sort of moving the portfolio ahead of Liberation Day. We had been trying to take a little bit of risk out of the portfolio, so we had added to a few positions of the fund. Ample, we added back into the fund for the first time in a while. We see that benefiting from both restocking post-COVID stocking declines or anomalies, and also we still think the acquisition of Berry is yet to be priced into the valuation. We continue to buy back a bit of Spark. Again, we've been underweight that for some time, but we do think at current levels we are, the stock is reflecting probably about a 15% dividend going forward, i.e. about 10% cut to the yield, to the dividend, and hence we think that's a bit of an opportunity. And then finally, we added Suncorp, where we basically see solid underlying earnings in the Aussie insurance sector, irrespective of the tariffs. And through that, we funded that through, again, lower conviction ideas such as GQG, James Hardie, and A2 Milk. Then moving across to the property fund, again, a difficult month in Australia and New Zealand, one of the worst impacted sectors in Australia. And again, the liquidity thing came to the fore, with most of the larger names in New Zealand off 5 to 10%, while the smaller names are unchanged. And we think there's obviously an opportunity going forward. I suppose the key thing to add in the property sector, particularly when looking at Australia, I think a lot of the weakness in Australia was down to, first of all, Goodman's percentage of part of the Aussie REIT index, as you talked about last month, but also the data centre phenomenon, which has been impacted. And again, probably got a little bit of further bad news on the back of DeepSeek, in addition to DeepSeek last month. So this month we got further announcements that particularly things like Microsoft was looking to be cutting capacity. But we did go and see HMC Capital last week in Sydney, and they were at pains to point out three key things. I mean, first of all, industry has tried to replicate what DeepSeek has done in terms of compute and the resource required to deliver it, and so far they've been unable to do that. So while we do think the ability or the compute percentage required in AI will reduce over time, I don't think the DeepSeek side of things is a particular risk or a reality as of yet. Secondly, this point about training versus inference. At the moment, all these AI models are about training their language models, teaching AI to do things such as ChatGPT solve problems. The reality is this is the first stage of the AI evolution or revolution. And, the next phase is essentially using these models to solve bigger and harder problems. And certainly the industry experts were essentially saying, look, this training side of things is probably going to be about 5% of the total compute used for AI over the medium term. So there is still a material requirement for compute resource going forward. And hence, we do think we need data centers over the medium term. And finally, just to make the point that obviously, Microsoft did walk away from capacity. Again, according to the expert, this is quite a regular thing to do. Essentially you're growing and then you realise that you're growing faster in different areas, and you just every year or so, stop and start again. The reality is Microsoft did realign their compute requirement, but people were very quick to step in and take up the slack, and so there was no real shortfall there. So overall, I think that data center theme continued to weigh on the sector, but we think it's probably overdone down at current levels. The other thing I would flag, and we've mentioned this in the past again, is the chart on the right. I mean, this is basically looking at the property sector in New Zealand relative to the 10-year bond. And, the reality is we do see, the sector as a beneficiary of interest rate cuts. First of all, because, the reality is I think they're probably carrying too much debt at the moment, and so cuts will lead to falling interest rates and lower interest cost headwinds over the medium term. But also that point I made about the yield relative. The reality is we think that the property sector yield is sustainable and tenable, and it's currently offering a gross yield of 8.5%, net about 5%. And I think worst case, it's going to stay flat over the next couple of years. That compares to a 4% term deposit, which again, if we do get further rate cuts, probably falls nearer to 3%, while our yield stays at 5%. And I think, as the sort of the options reduce and particularly that term deposit falls, we think the property sector will remain, an interesting area and an attractive yield for the wider market. And as such, and I think the medium term is looking brighter than the month of March. Anyway, I hope that's a useful summary. As ever, if you do have any questions about what's going on or what we're trying to do, please drop us a line at info@mintasset.co.nz. Again, we appreciate your support and looking forward to talking to you again in about a month's time.